All right, Ron. Hey, we're back for part two of our discussion. I know we're going to focus specifically more around what people are facing and some of the individual challenges that we have. I think right now, one of the things that really shocked me, and I read in a report, and again, I can't cite exactly where it was at. I think it was in Wall Street Journal, and it was maybe two weeks ago. But they were saying that the amount of cash that people had on hand, that in 2021, which was, I mean, I'm sorry, 2021 coming out of the pandemic, there was, and again, I don't remember the exact number, but just from the time of 21 to where we stand today, we're talking about something that was in the trillions of dollars of personal cash that was on hands that's now into the billions. And so we're talking a massive amount of money where people had just were flush with cash, and now everybody's there's a huge, massive uptick in amount of people that are at risk. I've got friends that are running pool companies where they're saying people are post-dating checks for pool still. I mean, there's some maniacal behavior when it comes to, it's like they can't get out of the habit of spending and doing what they were doing. But now it's like the cash flow perhaps isn't coming in like it was. And so, why do you think so many people are faced with this debt challenge? What's going on with this debt thing? Because it seems to be a major issue for our country.
Well, debt doesn't have the scarlet letter it used to have. The good book says the borrower is the servant to the lender.
Right.
And every time I step up to borrow money, I have to realize I have to service that debt. And for example, if I had gone to college and had a college loan, I signed a contract that says I'm going to pay that back. To forgive that breaks law, all kinds of economic laws. So it's just debt is it's okay to carry debt now. A lot of people believe. I've read where 9 out of 10 people are less than 90 days away from bankruptcy, that they couldn't stand a major hit for problems. And that's kind of sad.
Oh wow!
Because you gotta allow for emergencies. You know, air conditioners are going to break in Houston. I went through a bump the other day. No sign, no nothing. I thought, I'm glad I've got some coverage to those tires get torn up.
Yeah.
Tires on my car are expensive.
Because they're going. Well, and that's correct. With debt being with where it's at, we know that we're kind of in a flux situation right now. There's a lot of uncertainty out there. How, in your opinion, with interest rates the way that they are, how should people be adjusting their thought process maybe over the next 24 months? Again, not recommending, right? We're not recommending where to invest. We're simply saying, as you look at the next 24 months, what are some good ways to weather this type of storm?
Well, I'm going to use a tool we did when interest rates on home mortgages were at 18%. That was thanks to Carter.
Right.
And then Reagan pushed raise interest rates and break the back of inflation. It's called debt stacker. You take your highest interest debt first. Doesn't matter what the balance is. The highest interest first. And you diligently work towards that. And you become almost fanatical in that you only pay for cash. You don't, credit cards are only there for some kind of an emergency. You don't flip it out willy-nilly and say, I'll worry about it. I can make the minimum payments. That's a big one, is just focus on getting rid of any kind of consumer or non-deductible debt. The last place you'd want to pay off is your home. You got to live someplace. Those 7% interest rates on mortgages are pretty painful. But paying extra on your home with a 3.5% or 4% mortgage, give me a break. That's
right now you could put money in a bank account, earn 4% on it, and you're still getting the deduction on that interest. And the way the rational.
Let's talk about at 4%. I'm going to use a 25% tax bracket.
Right.
Net 3.
Mm-hmm.
Inflation is above 8. You've locked in a sure loss. But keeping liquidity is important. One of the things we talk about is luck. That stands for liquidity. You got to have liquidity for opportunities, but you also got to be able to use the money when it's appropriate. The C is control. In a 401k plan, for example, you don't have control of your money. You have whatever the company has decided, here's your choices. And the last is knowledge. Now, there are do-it-yourselfers out there that think that they are smarter than others. That's fine and dandy. But hopefully, we spend 2,000 hours a year minimum, all the requirements we've got by the regulators to keep up, et cetera, all our continuing education. Hopefully,
Just reps.
our knowledge is higher than most others, and we have multiple. I've probably done 25,000 plans in my career. 25,000.
Well, I'm blessed to be able to say I've had you help me with a number of them, and so there's so much wisdom that was imparted to me. And I think you're spot on. I was reading a book, and they were talking about, it was about sales, but the guy said, how much do you make per hour? And then ask how much you make per hour, and then say, where should you be spending your money? Should you be spending it on making more money, or should you be spending it on doing menial tasks? And not that managing your money isn't a menial task, it's a huge task. But for a lot of people, the research and behind the scenes work, trying to figure out what, and then call those shots. One of the things that I've gleaned so much of my wisdom from is that I don't have to go out and try to know it all, because I have you, George, Nick from our team, our CFP. It helps to be able to, I tell people immediately, I have 100 years plus of combined experience helping me come up with strategies, which to me feels a lot more comfortable than, when I was individually trying to, like, I got nervous, right? Because I'm managing my friends' money, and, I'd develop a relationship with these people, and I'd be like, God, I don't want to screw this up. Not that I'm free from that pressure now, but knowing that I've had multiple sets of eyes makes it even more convenient. So much, in fact, that I even leverage our team to help me make decisions for my own investments, which is great. Specific to this environment, I think bonds, we saw last year, and you mentioned it in our previous discussion, that bonds and stocks kind of both took a crapper in the same year, which is irregular. Now we're seeing the bond market start to pick up, and people are wanting to look there. So they're looking at I bonds and different type of bond portfolio and holdings, because when, those interest rates have risen, we're starting to see bonds pay more, right?
Yeah.
So just for our audience, because I've had a lot of my friends call me and, oh, hey man, I'm gonna put all my money into these bonds. And I started asking them questions like, okay, well, tell me why. And, it's paying this high interest or this CD or this, that. Okay, well, I guess the answer is, what are you trying to do with it? Because if you're just trying to park it somewhere to make extra money, what do you intend, back to your luck? Are you going to get unlucky if you need to use that money for something later and it's tied up in a perhaps a bond that you didn't understand how it worked? Perhaps you're losing money on the way out. For our audience in this environment, can you explain really how bonds work and maybe the things that somebody should be considering when looking into bonds, if that's a good place to be right now? Again, we're not recommending bonds. We are saying that, hey, a lot of people are doing it. So maybe you can give us a quick education on it.
It's an obligation to be redeemed at some point in the future.
Okay.
That's the first part of it. So what is the term of the bond? The other is, a big one is, does the person that's borrowing the money have the capacity to pay me back?
Got it.
Also so it's called debt coverage. Another one is, usually in these higher interest rates, they put up what's called a call back. They can call that bond back earlier than the maturity date, usually at a slight premium over their original price, because it's cheaper to refinance them. We had a refinancing boom not so many years ago, as an example. And then finally, it's just, as you said, what am I trying to accomplish by this? Life insurance companies use a lot of bonds because they can look at it's a group of large numbers. So they take 1,000 people age 40. They know on average how many of them are not going to make it but so long. All they do is they match their liabilities, because if they've got to pay $1 million claim in 5 years on 5 people, they better have $5 million out there.
Right.
So, and that's the beauty of what bonds do for them, is it enables them to match those liabilities. And to get decent credit worthiness, they have to have 3-4 times what is there. So they anticipate claims of $5 million. They may have $20 million worth of bonds maturing in 5 years.
Oh, wow.
Simply to match it in case there's a plane crash, COVID, all the other things that occur. When 9/11 occurred, you had roughly 3,000 lives that died in one day.
Mm-hmm.
Those are aberrations, but they occur. So bonds are an instrument that gives you predictability. And if you hold on to them to maturity, they're going to mature. Just today, my wife was looking at a bond that's trading at 105. It's 5 3/8 above its par value.
Yep.
And I said, why don't we give that away to the church? we don't need the interest on that bond.
Right.
Because of the interest rate, it trades above value. Now, if it was a lower interest rate, it would have traded below value.
Right. When that so that's one thing I want to explain is when bonds, as interest rates go up, bond prices go down, and as interest rates go down, bond prices go up. And the correlation to that directly is that what you pay for a bond today, let's say it's turning out 5% interest when you buy it today. Those interest rates rise up. It's going to cost less because somebody can go buy another bond that pays more, right? So my own personal example of that is I bonds. I bought I bonds right when all this interest rate, because everybody was talking about, oh, you got to get into some I bonds. So I threw a little money into I bonds right as inflation was peaking. Not really considering, again, it's more like long money for me, so it wasn't a big deal. But one learning curve for me was I wasn't thinking about how high they were going to hike these interest rates. And now that I bond, while I'm getting a great return, it's like 8% return on it, which is phenomenal. Its value's gone down significantly because they hiked the interest rates up. So I was right at the season, right before they started hiking them. So I've watched its value drop dramatically. So if I was to exit that bond today, I would actually take a loss. So now I've got to wait all the way until interest rates start to recover for it to then bring its value back up. Because someone else can go out and buy another I bond right now, high interest rate, better interest rate, but at a cheaper cost.
And that's a perfect example of what happened to that bank in California. I'm not going to name the bank, but they just were taken over by the FDIC.
Right.
Because they were bringing tons of money in on IPOs and other things. And they looked at the yield curve and they pushed way out in the yield curve when interest rates were low. Interest rates rose. The underlying value of those bonds shrunk substantially. People got panicked, said, give us our money. They took a big loss. It's that same kind of thing. But they were forced to sell in a bad environment. And that's where you can really get clobbered. And that's unfortunately the dangers of bonds if you are particularly trying to trade them or you think you can maneuver the market.
Yeah, and that's why I think it makes sense to have a team behind you looking at the total picture. And I always like to bucket my clients' money into what I call short money, mid money, long money, and then really blend a comprehensive plan to include all of those things based on what their life is dictating is going to happen up front. So, it's not a cookie cutter approach. And one of the things that I observed in our current environment is because we reverse engineer our plans with the end in mind and then work in 2, 4, 2, 5, 10-year segments, we are always looking at assets as what's the most efficient way to get these assets, and then what would we have to pull from and in what order over the next 2 years, 10 years, 20 years, 30 years, and then make sure we have those investments layered with that thought process in mind. And fortunately, it's been a blessing because I followed that same approach. And since I've been investing with our style of management and in investing in our strategies, I would say that I've weathered a pandemic, ups, downs, and down economic battle, but kept stress out of my home because our money are in the right buckets. I'm never feeling like my money. I know my money that's down in the market right now, I'm comfortable with because I that's my long money. Because I've already had money earmarked for my mid money, and if I wanted to go buy a house that's on sale right now, I could because I had it earmarked in investment styles that support that. So I think it's really about strategy, putting it all together. And then taking the market, the considerations, what's taking place in the market, and your own personal scenarios to build it the right way. Ron, we're going to probably run out of time.
Let me share one other thing that
please.
I use, or I did use, you made me think of when you said that. Talk about ABC. A is accumulating money, and it should have a time frame more than just a couple of weeks. B is benefits that occur. So Social Security, Medicare, those are benefits. If you have a pension at work, which less companies do, but some kind of benefits that come in. And then cash, two reasons for cash. One is for emergency, 2 for opportunity. But ideally, you want to have a replacement tool or a way to recoup, especially if you have on the accumulation side, a downside when you're making a transition. For example, people retired on January 1st of 2022 who were in index funds got hurt pretty bad.
Yeah.
As an example. So ABC
is the way we're seeing that, right? Yeah. And then I'm sure a lot of people are having to push back retirement dates just because of the current environment. And then that without that thought process, I've sadly ran into some folks who weren't positioned the right way. That are becoming clients of mine. They're advisors lost a lot of their money because they just weren't looking at the cliff and thinking about what would happen if they fell off. So, all right, Ron, I think because of our timeline right now, what we'll do is we'll transition and then hold some of our other questions for another discussion.
Okay.
Because I think it'd be relevant. I think we could have an entire other discussion on some of the great things that are happening in our market. But as we wrap up, I would love to get at least one nugget from you that is more relevant to you, right? Like what makes Ron tick. And I think we want to encapsulate that. And so, Ron, you've been doing it for 55 years. You don't have to do it, right? You could be at home, but you're still coming into the office 3-4 days a week. You're contributing.
Oh, I'm trying to keep it under 2.
Maybe under 2, but I still see you here, which is great. And but not, like I said, not because you have to be, but because you're bringing tremendous value. And for the last 10 years, you haven't had to do it, but you still did it. And so I'd love to know why, your why. What makes you continue to get up every day and still get out there, put on a shirt, put on dress pants, shine your shoes or get your shoes shined, and then show up to do this kind of stuff.
Well, I really thought about this question, and I said that I recognize God has gifted me with certain things, and I want to try to focus on the 3 things that I'm really blessed with, and part of that involves this kind of work that I'm doing now. I have expanded it to help mostly men in their own personal walks also, but it's trying to make the journey of my clients a little bit more joyful and with less stress and fear in it.
I love it.
If I can do that, that's good.
Well, you made my life more joyful in the 5 years I've had you in it, so that's for sure. So it's working.
At least one person is benefited.
So it's worked for one person. So, all right. Well, hey, I appreciate this discussion today. I think we're definitely going to have a round 2 after we get this one produced and released, and so we'll gear up a few more questions, bring you back in again, the old bull and the young bull, and then as a reminder, I want to remind anybody that tuned in to listen to this that, as always, anything that we said or spoke to on this show, we're by no means any type of individual recommendation. We're not recommending any type of things, bonds, stocks, nothing specifically real estate. We're just educating you on perhaps how they work, but again, making no recommendations for anything individually. So thank you as always.
Thank you.